It wasn't a secret handshake in a smoke-filled room in Davos. It wasn't a glitch in the algorithmic code of high-frequency traders. It wasn't even a coordinated political ideology pushed by a single party. It was a structural inevitability born of mathematics. The consolidation of wealth you are witnessing is not an accident. It is not a mistake. It is the logical endpoint of a financial system designed to prioritize scale over competition. We are watching the greatest accumulation of capital in human history. Assets are moving from the hands of the many into the ledgers of the few. The middle class is not being destroyed by malice. It is being dismantled by efficiency. The arithmetic is merciless. When the cost of capital approaches zero, the largest players do not just grow, they absorb. They metabolize the economy. They become the market itself. You look at the housing market and see prices that defy logic. Look at the stock market and see valuations detached from reality. You look at corporate boards and see the same names, the same voters, the same proxies. This is not a conspiracy of men. It is a conspiracy of incentives. The mechanism is blind, but the outcome is clear. We are transitioning from an ownership society to a rental society, from a citizenry of proprietors to a population of tenants. The data is unambiguous. The trend lines are ironclad. And the entity at the center of this gravitational pull is operating exactly as the rules allow. This isn't prophecy. It's positioning under constraints. To understand how a single firm can effectively own the world, we must first understand the history of elite positioning. We must look at how capital reacts when it encounters a limit. Throughout history, when the financial system reaches a saturation point, the smart money does not panic. It consolidates. It changes the rules of ownership to protect itself from the volatility of the masses. We have seen this play out 3 distinct times in the last century. The names change, but the mechanics of control remain exactly the same. Case File 1 takes us back to the autumn of 1907. The location is New York City. The constraint was liquidity. In the early 20th century, the United States had no central bank. There was no Federal Reserve to print money when panic set in. The economy ran on trust, and in October 1907, the trust evaporated. The trigger was a failed attempt to corner the stock of the United Copper Company. When the scheme collapsed, it took down the Knickerbocker Trust Company, one of the largest financial institutions in the city. The panic was visceral. Long lines of depositors formed outside banks, desperate to withdraw their life savings. The contagion spread instantly. Stock prices plummeted, credit froze. The engine of American commerce ground to a halt. In this vacuum of authority, one man stepped in: J.P. Morgan. He was not an elected official. He was not a Treasury Secretary. He was a private banker, but he understood the constraint. He knew that if the system collapsed, his own empire would fall with it. The incentive was survival through control. Morgan summoned the city's leading bankers to his private library on 36th Street. He locked the doors. He told them they would not leave until they had pledged their own capital to bail out the trust companies. He forced them to act as a unified entity. He effectively created a central bank out of private capital. But the aftermath changed the structure of American ownership forever. This led to the Pujo Committee hearings in 1912. By sitting on the boards of competing railroads, steel mills, and banks, Morgan ensured that competition was suppressed. He replaced the chaos of the free market with the stability of a monopoly. A lesson from 1907 is critical for today. Morgan didn't just save the banks, he acquired the leverage to dictate the future of American industry. The constraint was chaos. The solution was consolidation. The stock market, which had been the engine of middle-class wealth, was dead in the water. The old model of active stock picking, where an investor analyzed active managers could not beat the market. The incentive was to minimize cost and capture the average. This era birthed the index fund. John Bogle founded Vanguard in 1974, launching the first index investment trust. At the time, it was ridiculed, as Bogle's folly. Wall Street laughed at the idea of settling for average returns. They believed in the superiority of the stock picker. But Bogle understood the arithmetic. He knew that over time, the fees charged by active managers compounded, negatively destroying wealth. The mechanism was passive investing. Instead of owning a piece of a company because you believed in its management, you owned a piece of the entire market because you believed in the system. This seemed democratic. It seemed like a win for the little guy. And initially, it was. But think about the structural shift this initiated. As trillions of dollars flowed into passive strategies, over the next 40 years, the nature of ownership changed. When you buy an S&P 500 ETF, you are not voting at shareholder meetings. You are not holding the CEO accountable. You are handing your voting rights to the firm that manages the index. The rise of passive investing created a vacuum of corporate governance. The asset managers, the firms that built the ETFs, began to accumulate the voting power of millions of individual investors. The Nifty 50 crash of the early 70s proved that chasing popular stocks was dangerous. The index fund offered safety, but the safety came at a price: the separation of ownership from control. The actual owners of the capital, the teachers, the nurses, the firefighters, with 401 kiloseconds, became silent partners. The managers of the capital became the voice. The constraint of the 1970s market failure led to the positioning of the asset manager as the supreme arbiter of law. Corporate America Case File 3 brings us to the precipice of the modern era, the global financial crisis of 2008. The constraint was complexity and toxic debt. The banking system had gorged itself on subprime mortgages, repackaged into securities, so complex that even the people selling them didn't understand the risk. When the housing bubble burst, the balance sheets of the world's biggest banks were revealed to be insolvent. The incentive for the government was to prevent a total collapse of civilization. The incentive for the private sector was to acquire distressed assets for pennies on the dollar. But there was a problem. The U.S. Treasury and the Federal Reserve did not have the technical capability to analyze the trillions of dollars in toxic assets clogging the system. They needed a manager. They needed someone who could look into the abyss and do the math. Enter BlackRock. Founded by Larry Fink, the firm had developed a risk management system called Aladdin. Aladdin was not just a database. It was a lens that could see through the opacity of the mortgage-backed securities market. When the government needed to manage the assets of Bear Stearns and AIG, they didn't call a bank. They called BlackRock. This was the moment of the great positioning. Just as J.P. Morgan had stepped into the void in 1907, BlackRock stepped into the void in 2008. But unlike Morgan, who used personal prestige and private capital, BlackRock used technology and government mandates. They became the fourth branch of government. They were awarded no-bid contracts to manage the bailout. The mechanism was the integration of public policy and private profit. By managing the government's portfolio, BlackRock gained an information advantage that was unparalleled. They saw the flow of funds before anyone else. They understood the regulatory landscape because they were helping to shape it. The outcome of 2008 was the death of the traditional investment bank model and the rise of the asset management giant. The crisis destroyed the competition. It forced consolidation, and it flooded the world with cheap money quantitative easing. This cheap money had to go somewhere. It couldn't sit in savings accounts earning 0%. It had to hunt for yield, and this hunt for yield is what brings us to the present danger. The pattern across these three case files is unmistakable. In 1907, the constraint of liquidity led to the money trust. In the 1970s, the constraint of inflation led to the index fund. In 2008, the constraint of complexity led to the universal owner. In every instance, the solution to the crisis involved moving power away from the individual and toward the aggregator. Now, we must examine the constraint engine that drives the current consolidation. This is the machinery that turns your retirement savings into the weapon that outbids you for a home. The engine runs on three specific fuels: passive flows, ESG mandates, and the yield trap. First, let's look at passive flows. Today, for every dollar that enters the stock market, the vast majority goes into passive vehicles, ETFs, and index funds. BlackRock, Vanguard, and State Street control tens of trillions of dollars in these assets. This creates a phenomenon known as common ownership. These three firms are the largest shareholders in 88% of the S&P 500 companies. Think about the incentives here. If you are a major shareholder in American Airlines, Delta, and United, do you want them to compete aggressively on price? Do you want them to lower fares to steal market share from each other? No, that would lower the overall profit pool. You want them to maintain discipline. You want higher prices and stable margins. Common ownership softens competition. It acts like a silent cartel. It is not illegal collusion. It is simply rational positioning. The constraint of beating the market has been replaced by the incentive to own the market. Second, consider the ESG. Mandate environmental, social, and governance criteria. This is often framed as a moral imperative, but you must look at it through the lens of capital control. ESG acts as a filter. It allows the largest asset managers to direct capital flows based on compliance. If a company does not adhere to the standards set by the asset manager, it can be cut off from capital or face a shareholder revolt. This creates a massive barrier to entry for smaller competitors. Compliance is expensive. Large corporations can afford the armies of consultants needed to navigate ESG scores. Small independent firms cannot. Therefore, ESG becomes a moat. It protects the incumbents and consolidates the market further. It is a constraint that favors the giants. Third, and most critical for the average American, is the yield trap. This is the mechanism destroying homeownership. Following 2008 and accelerated by the pandemic in 2020, interest rates were held near zero. Bonds paid nothing. Savings accounts paid nothing. Pension funds, which need to pay out 7% or 8% a year to retirees, were starving for yield. They couldn't get it from safe government debt. So where did the money go? It went into real assets. It went into housing. But not just buying mortgages, buying the houses themselves. Institutional investors realized that in a world of zero yield, a single-family home in a suburb is not a place to raise a family. It is a bond that pays rent. It is an asset with a steady cash flow. The constraint was the lack of yield in the financial markets. The incentive was to turn the American housing market into a stock market. The mechanism was the all-cash offer. When a young couple tries to buy a starter home, they are coming to the table with a mortgage, pre-approval, a financing contingency, and a personal letter to the seller. The institutional buyer comes with cash, no contingencies, and a closing timeline of 5 days. The arithmetic is merciless. The institution can accept a lower return on the property because their cost of capital is lower. They are borrowing money at institutional rates or using the trillions in pension fund capital that needs to be deployed. They are not buying a home. They are buying a line item on a balance sheet. This pushes prices up. It pushes the price-to-income ratio to historical extremes. It creates a permanent class of renters who are priced out of the equity accumulation that built the American middle class. Mapping this onto the present, the data suggests we are entering a new phase of economic structure. Some economists call it techno-feudalism or neo-rentierism. The terminology matters less than the reality. The reality is that the gap between asset owners and wage earners is widening not because of salary differences, but because of asset inflation. If you own the assets, the stocks, the houses, the land, the inflation of the money supply makes you richer. If you sell your labor for a wage, the inflation of the money supply makes you poorer. BlackRock and its peers are the ultimate asset owners. They are positioned on the right side of the equation. They have effectively solved the problem of inflation for themselves and their clients by owning the things that inflation makes more expensive. Current data suggests that institutional ownership of single-family rentals is still a small percentage of the total market, perhaps 3 to 5%. However, this number is misleading. In specific markets, Atlanta, Phoenix, Charlotte, the concentration is much higher. And more importantly, they focus on the buy box, the exact type of starter home that first-time buyers need. By controlling the marginal inventory, they set the price for the entire market. There is a counter-argument to this. Defenders of the asset management industry argue that they are democratizing finance. They argue that ETFs have lowered costs for investors, saving Americans billions in fees. They argue that by professionalizing the rental market, they provide a better service than the slumlord of the past. They point out that BlackRock manages money for teachers and firefighters, so when BlackRock wins, the pensioners win. This is technically true, but it misses the structural cost. The efficiency of the ETF comes at the cost of price, discovery, and corporate governance. The professionalization of the landlord comes at the cost of the ownership ladder. The incentive for the asset manager is to maximize fees and assets under management. The best way to do that is to ensure that asset prices keep rising. But if asset prices keep rising faster than wages, the social contract breaks. The pensioner might get a slightly higher return on their 401k, but their grandchildren cannot afford a house. The capital gains of the older generation are extracted from the rents of the younger generation. It is a closed loop of wealth, transfer managed and skimmed by the firms in the middle. We are now staring at 3 potential endgames. The trajectory is set, but the destination depends on how the system breaks. The first endgame is controlled decline. In this scenario, the consolidation continues, but at a managed pace. The government works hand in glove with the asset giants to maintain stability. We see a slow erosion of ownership. The home ownership rate drifts down from 65% to 50%, then to 40%. The subscription economy expands to cover everything: cars, housing, appliances. You own nothing and rent everything. The corporations act as benevolent feudal lords, providing stability in exchange for permanent rent extraction. This is the path of least resistance. It mirrors the late Roman Republic, where the independent farmers were slowly absorbed into the massive estates of the patricians. The second endgame is chaotic collapse. This occurs if the political backlash becomes unmanageable. If interest rates spike and stay high, the leverage in the system blows up. The institutional landlords, carrying massive debt loads to finance their portfolios, could face a liquidity crisis similar to 2008. If they are forced to liquidate millions of homes simultaneously, the housing market crashes violently. This would wipe out the equity of the remaining middle class and destroy the pension funds that are invested in these schemes. This mirrors the panic of 1907 or 1929, a sudden violent unwinding of leverage. That leads to social unrest and radical political change. The third endgame is reset and restructure. This is the most complex, but perhaps the most likely long-term outcome. Here the state steps in, not to break up the giants, but to merge with them officially. We see the introduction of central bank digital currencies, CBDCs, and direct stimulus that bypasses the banking system. The asset managers become the utilities of the new economy. Housing might be nationalized and all, but name with rents capped and subsidized by the state, but paid to the private consortiums. This is a move toward a command economy disguised as capitalism. We saw glimpses of this during the pandemic with the eviction moratoriums and direct payments, a historical precedent. For this is the post-war restructuring in Britain, or the New Deal in the U.S., but with a modern technocratic twist. The ownership of the underlying assets remains concentrated, but the pain of the population is subsidized to prevent revolt. The only variable is timing and paying. The structures are built, the capital is deployed, the incentives are aligned. The transition from a nation of owners to a nation of renters is not a future possibility. It is a current operation. The firm at the center is simply the most efficient engine of this transition. They are not villains in a comic book. They are fiduciaries in a broken system. They are doing exactly what the math demands. To navigate this, you must understand that the era of passive accumulation is ending. You cannot simply ride the wave of general growth. If the growth is being captured by the top, you must educate yourself on the specific mechanics of value. You must understand the difference between currency and money, between price and value, between ownership and a claim on ownership. Pay attention to the flow of funds. Watch the regulatory changes that favor scale. Build resilience not just in your portfolio, but in your skills and your community. The great consolidation is underway, but history shows that even in the tightest grip of monopolies, there are cracks, there are pockets of independence. Find them, hold them, subscribe to continue this analysis. We will keep tracking the data, the legislation, and the movement of capital. Landscape is shifting, and clear sight is your only advantage.